We are covering the rules for traditional IRA distributions, focusing on what you need to know for the enrolled agent exam. The baseline rule for any traditional IRA is that distributions are taxable as ordinary income. If the IRA owner made any non-deductible contributions, a portion of the distribution will be a tax-free return of principal, calculated using Form 8606. The exam, however, focuses heavily on the penalties and exceptions. The primary rule to remember is the age 59 and a half rule. If a taxpayer takes a distribution before reaching age 59 and a half, the taxable portion is generally subject to a 10% additional tax, often called the early withdrawal penalty. Exam questions are designed to test your knowledge of the exceptions to this penalty. One major exception is for a first-time homebuyer, who can withdraw up to a lifetime maximum of $10,000 penalty-free. An exam question might describe a 40-year-old taking a $25,000 distribution to buy their first home. You must know that only $10,000 is exempt from the penalty. The remaining $15,000 is subject to the 10% tax in addition to regular income tax. Another key exception is for qualified higher education expenses for the taxpayer, their spouse, children, or grandchildren. Unlike the homebuyer rule, there is no dollar limit here, but the distribution cannot exceed the amount of the qualified expenses. A common exam trap involves a taxpayer withdrawing more than needed. If tuition is $12,000 and they withdraw $15,000, that extra $3,000 gets hit with the 10% penalty. Other critical exceptions you must know include distributions due to death or permanent disability, distributions for medical expenses exceeding 7.5% of adjusted gross income, and distributions taken as substantially equal periodic payments, or SEPPs. A SEPPs plan is a way to create an early retirement income stream, but it requires taking specific, calculated payments over a long period. The exam will test whether you know this is a series of payments, not a single lump sum. Now, let's discuss required minimum distributions, or RMDs. The exam expects you to know that these must generally begin once the IRA owner reaches age 73. The first RMD must be taken by April 1st of the year following the year the owner turns 73. A classic exam question involves the timing of the first two RMDs. If a taxpayer delays their first RMD until that April 1st deadline, they must still take their second RMD by December 31st of that same year, resulting in two distributions in one tax year. This can have significant tax implications. A powerful tool for taxpayers age 70 and a half and older is the Qualified Charitable Distribution, or QCD. This allows a direct transfer of up to $105,000 for 2025 from an IRA to a qualified charity. The amount of the QCD is excluded from the taxpayer's gross income and, importantly, can be used to satisfy their RMD for the year. The exam will test the details. The taxpayer must be at least 70 and a half, and the funds must be transferred directly. If the taxpayer receives the money first and then donates it, it is not a QCD. To keep the main penalty exception straight, remember the acronym HOMES. H for first-time homebuyer, O for out-of-pocket medical expenses, M for medical insurance premiums while unemployed, E for education expenses, and S for substantially equal periodic payments. Remembering HOMES will help you quickly identify a valid penalty exception in a complex exam scenario.